This podcast is brought to you by Iris TV. Streaming is now bigger than broadcast and cable, but we all watch our favorite shows and movies on hundreds of different devices and apps. Iris TV makes it easy for advertisers to target viewers with precision at scale across all these platforms. They do this by enabling AI to analyze millions of videos from the leading publishers to create the largest contextual data marketplace for streaming. By building their campaigns with Iris-enabled data, brands like Carl's Jr. are driving higher lifts in awareness and sales while publishers are generating higher yield. Learn more about Iris TV and explore their private marketplace deals by visiting iris.tv/PMP. That's iris.tv/PMP. Welcome to the Marketecture Podcast. We have a great show today. So I'm joined by Craig Kostelic, who is the Global Chief Business Officer for Conde Nast, and we're going to talk about the open web and how publishers are seeing the world and how they relate to the walled gardens and monetize in those environments. A lot of interesting stuff there. And then a monster week of news with Outbrain Taboola and a bunch of other deals and earnings and all kinds of good stuff. This week's vendor interview on Marketecture is with OpenX. So we had an interesting conversation about their curation efforts. Curation is the name of the game, and they're really doing some interesting things there. And then I want to announce a big new initiative. So starting next week, I'm going to be publishing weekly or sometimes more than weekly updates about the Google antitrust trial in a new newsletter. We're calling it the Monopoly Report. The first issue comes out on Monday, and you're going to get it if you're subscribed to the Marketecture newsletter. And then we'd ask you to subscribe if you want to keep up to date on the ins and outs of the Google antitrust trial. I'm very excited. This is my Super Bowl. This is my Roman Empire. I'm ready to go. So please watch out for that on Monday. All right, let's get into it. Craig Kostelic, thank you so much for being here.
Pleasure. And also, who thought of the Monopoly Report? Who gets credit for that?
Okay, my wife and I are arguing about this because I went out to the couch and I told her the whole deal, and she said something interesting, something about, hey, you should use the Monopoly Man because that used to be your avatar in social, and then I came up with it. So she claims credit for inspiring me. I say she's just a muse and I'm the creative genius, but I think she's in the other room, so I probably shouldn't talk so loud. She'll probably jump in on the podcast and have her own point of view.
I like the marketing, though. I would just say, as somebody that works for, I think the highest level of creative and culture development in the world, I just wanted to give you a tout for your creative acumen.
Appreciate that. I'm good at naming things.
What a compliment. Wow.
Yeah, I know, right?
And you have to butter up the host. That's how you start this conversation.
Well,
I see.
I'm having you on the show mostly so I could get an invite to the cafeteria. That's the main objective here.
I got you whenever you want it.
All right. So Conde Nast, everyone knows it, but maybe isn't as on top of what you're doing in terms of moving your business into the open web, into this modern, complex, difficult environment. So why don't you just take us through, what's your strategy? What's going on?
Yeah, absolutely. Again, thank you for having me. I mean, I've been here for, believe it or not, it'll be 13 years in December. So I started when I was 26, which is kind of crazy. And it's kind of like been broken up into like almost like two big chapters, I would say, right? Like when I started here in 2011, 2012, it was really the beginning of like print starting to actually, decline. I think the news of the demise was way before it kind of actually happened, but early 2010s is where you really started kind of like a precipitous drop, and that's obviously continued over the last like decade or so. And so the first part of that was open web websites, figuring out how to create experiences that were as good of a user experience as print and as profitable, or ways that you could monetize kind of like the expression of the brand in a way that the print business was very successful for a very long period of time. And I think very recently, it's been kind of this like new shift. And I really think at a baseline, when you look at the impact that search and social have had, right? At the beginning of this, I would say they're discovery platforms, whether it's content discovery or product discovery. These were inherently discovery platforms in which you would use the platforms to discover things, and then you would consume those things off the platform. And obviously, very recently, over the last, 24, 36 months, there's been a significant shift in the focus around keeping you on the platform and all the consumption happening on the platform. So for us, you have to kind of like step back for a second and have some observance about the fact that like no longer is the goal to say, hey, this is what one of my brands is doing on your platform, and then figure out how to like materially monetize them somewhere else. You now have to focus on how am I building an economically viable model on top of the foundation of those consumption platforms.
Right. And that goes for all the social platforms. It even goes for Google search. Their referral traffic is down across the board. People are spending more time in the social apps or the various apps than going out to, say, a website.
100%. And, we've always been dealing with the fluctuations of that. But when you see things like, one of the biggest wake up calls for me, at least, which was very recently when Meta was public about this, is when they have a press release that says, we're spending billions of dollars investing in AI in our video ecosystem, and the main KPI is to increase time spent. So when they're saying that, I'm talking to every CMO and I'm saying, I just want to be clear with you, like if you're using the same social strategy that you were using 4 or 5 years ago, that means that I'm going to spend money on the platform to get people to buy something off the platform. Your dollars are at odds and are helping to fund the KPIs of the engineers on the platform that are actually going completely antithetical to your advertising strategy.
That's a great way to look at it. There's ultimately only so much time in the day. So if you increase time spent, you're going to decrease it elsewhere.
Yeah, and it's been fascinating too. Like, I don't know if you guys ever saw this. There's a great, I think it's eMarketer, does this kind of like time spent versus the share of composite of advertising. And when you look at, it's like Meta and it's like, I don't know, 20% of total digital ad budgets and like 5% of time spent. I might be getting these numbers wrong,
right,
but
sure.
it's really a huge delta. And then like the next is like, I don't know, TikTok, which is like 4 and 4, YouTube, which is 5 and 5 or something. Hulu actually had the biggest disconnect between they have more time spent than they do of total ad budget. But that just goes to tell you that, Meta just came out with earnings, I guess, yesterday, right? I think, and crushed it. But the reality is at some point, like they can't get higher shares of digital ad budgets globally without increasing that time spent number. Like that delta can't keep getting wider if they're going to continue scaling their business. And so that only means one outcome, which is like the less and less people are going to be leaving that platform. And so then it's like, okay, well, if that's the case, then what do I need to do about that? How do I need to think about my commercial strategy? And that's really thinking about content experiences on those platforms and then how I'm monetizing those actually on the platform.
Yeah, so I want to go to that, but I sort of teed up this conversation by talking about the open web, and immediately we went to the walled gardens. So Is that a sign that the open web is a lower priority or a declining medium, or is there still the belief that it could be, fertile ground for monetization and audience?
I use an analogy, I would say, about our business overall. Like if you look at an LVMH, if you look at any of their brands, they have couture, which is usually it's the highest expression of the brand, usually doesn't make money. You have ready to wear, which is like kind of like that, premium, kind of like, the baseline of the business. And then you have beauty and accessories, which are entry price points and where they make all their money. Right. So when I think about the future of our business, I look at print and events as our couture, because the thing is with print and events, it's like, even though those might not be like, those aren't going to be the growing parts of the business, when you have 10 covers or 12 covers a year, talent wants to be on the cover of Vogue. Talent wants to be, when you see the GQ covers we have coming up in the next 5 or 6 months, it's insane, right? The covers give you the access to the talent, which is combined with our brands making culture, which is our whole value proposition, right? And so I really look at this like print and events is our couture, websites and open web is our ready to wear. And then the business that we're talking about building on top of the walled gardens is beauty and sunglasses and accessories. And I think what's really interesting is only, like, in my opinion, you can increase the scalability and the spread of the social business by maintaining the equity in the couture side of the business, right? So that's why you see, I think, I'm seeing Brian later today for lunch at Bustle, but it's like when they bring nylon back on print, it's to create an equity for the brand that then allows him to build all these other businesses, right? And so to answer your question about the open web, I think it's going to be a big part of our monetization strategy for a long period of time. I look at it as a mature business, and you're going to kind of mitigate decline and try to keep it as steady as you possibly can, given all the headwinds. But really, like, all the growth is really going to come on what are we building on top of YouTube? What are we building up on top of TikTok, assuming that that's still around? on Meta, on Pinterest, etc.
This is like the digital media version of the cerulean speech from The Devil Wears Prada.
Yeah, very much. So get into that. How does a publisher, media company, content owner, how do you make all of your money on these walled gardens? Like, what's the plan?
Yeah. So I'll start with I kind of when I think about how do we grow this business and scale it, I always kind of start with what are the biggest challenges to doing that as we sit here today? And I would say the two inherent challenges that we have are activation. So obviously, if you're using our handles on social, if you're using our creative, if you're using our data, whatever, it's a managed service versus if a marketer is going to go directly on platform, it's going to be a self-service, right? And so right now, social investment dollars, you're kind of competing against internal resources who are hands-on keyboard. So that's a fundamental challenge, right? Is just kind of the workflow and the activation around doing that. And I think the second part is transparent auction-based models, right? Obviously ours is a non-transparent model. We have, developed rate cards that essentially look at how much it costs to buy an impression or a view or a click on a platform, what the margins make sense for our business in context to the equity and the value that our brands create as being part of that experience, right? And so while that construct can exist on, we look at programmatic, right? You have open exchange, and then you have private marketplaces in which you are paying a premium to guarantee the contextual environment of your message. Because social all started off as open exchange, right? We're at Conde Nast trying to build essentially a social private marketplace, a premium contextual experience on top of all these walled gardens. But, when you're doing that and inherently it comes at a premium and you're starting at the most commoditized, cheapest version of that transaction, it's a huge headwind. You know what I mean? And so I kind of think about it, okay, those two things, it's okay, then what do we need to figure out, to your point, in order to scale those businesses? And that's why, I'm really excited about this Pinterest partnership that we're launching that I sent you guys, Sahil at The Information wrote a piece about it earlier this week. But essentially what that's going to do is it allows us to work with advertisers and take the full value of their IO and put that into their Pinterest client ad manager. From there, they're able to use all the creative that we worked on as part of the campaign. They're able to leverage our, boards that we're working with them on that include our brands and their brands. And they're able to execute the buy hands-on keyboard in a transparent auction-based way. So the execution and the funding and the cost structure and the workflow, exactly the same working with Conde Nast in this flow as it would be with working with Pinterest directly. And the rev share is between us and Pinterest. So what's really exciting is the two main challenges, that I just talked about in terms of workflow activation and cost structure is solved through this kind of really modern partnership that Pinterest developed for us.
Yeah, that's really interesting. Does Condé Nast and its properties have a lot of audience on Pinterest? Is that the part of it?
Yeah, I mean, a decent amount, I would say. Definitely not, our focus has been for sure, Instagram, Meta overall, TikTok, and YouTube for sure. So I don't want to, Pinterest is in line with that prioritization. But I would tell you this is I'm sitting, we have quarterly brand meetings with editors and all the cross-functional teams. Our team, the commercial team, is making sure to be in those meetings and being very clear about educating all of our editors on this partnership because, obviously you want to put your content and your brands where audiences are at, but it's equally important to really for our editors and our creatives to really understand where we have the most advantageous commercial terms that really allow us to build a sustainable business. What platforms are enabling that and making sure that we're prioritizing those platforms accordingly. So we have a solid presence. Pinterest is, I think skews kind of female, skews, beauty and things of that nature, right? And so I think given our portfolio of brands, we do have a pretty decent sized audience there. But I think that you're going to see us have more of a focus when you look at things like Allure Best of Beauty, when you think about Glamour, Women of the Year, those big franchises that we have that have a real focus on female audiences. I think we're thinking about how do we do something unique and exclusive for Pinterest that creates excitement around the content and the brands, plus then having this partnership and how those things work together.
Is there one Condé Nast level strategy for, say, Instagram, or do each of the brands figure out what's appropriate and how to staff it and things like that?
Yeah, I think, it's kind of this like middle way, I would say, in terms of like the content strategy is definitely decentralized at the brand level. And then there's kind of, I think, best practices around, time of post, frequency of post, things of that nature that they kind of create almost like parameters or bands of best practices for each brand to activate against.
Right. And then what about the actual content? Like you could be quite edgy on, say, TikTok, but that may not be appropriate for a brand. Is that just up to the editorial side to figure out where the lines are?
Yeah. There's a lot of, I would say, analysis and kind of like feedback loops. At the end of the day, our editors, our creatives, they make the final call on that for sure. Because a lot of times it's like, while there's huge value in the feedback loop for optimization, a lot of what our brands do, like, and especially when you look at like something like Vogue, right? Like, they're not using marketplace feedback to create a trend, right? Like, they're just like, it's intuition because you just have the highest level creative talent in the world.
Right, right. For a while, it was very trendy for media companies to get into commerce. And I'm wondering, given the Conde properties and how involved they are in beauty and fashion and things like that, how important is commerce and is there a play in retail media?
Really, I think our commerce, we have somebody that was a former, used to run Net-a-Porter. It was at Neiman Marcus too, that now oversees commerce for a lot of our brands. And I would say this is that we've kind of evolved our commerce strategy. I think the first chapter of it was very like, let's put articles up about like the 10 best looks and like we'll link to them, drive off site and take a commission. We now, like if you go on vogueshopping.com, it is like a Net-a-Porter like experience where there's like on the left rail, there's, product categories. Like you can actually navigate it from a product focused approach like you would on a pure retail site. And so what you see is kind of like the affiliate inspirational content and then the product, kind of like that product UX and UI and how those two things kind of like collaborate together in order to drive an outcome. Now that's kind of like I would say like our little version of like our owned and operated retail media experience. But I would tell you this is like, when I look at like the Saks and Neiman merger, to me, once they get through that, like I think there's a very interesting conversation to have around, to your last question around retail media. I look at like the Best Buy and CNET thing, and I think there's such a huge opportunity to do that. I mean, we have a huge partnership. It's not retail media. Like we're not yet taking this to other brands, but we have a huge partnership with Amazon Beauty around Allure Best of Beauty, in which we are creating Allure storefronts on Amazon Beauty. And this is going to be the second year of the partnership. Last year was incredibly successful. They renewed it for this year. But to me, like what I'm talking to the team about is I want to evolve that. And so I want to be able to talk to P&G. I want to be able to talk to Unilever. And I want to say, hey, how do you use the platform of Amazon and the content of Allure? And how do we have a content retail media component? Like, to me, that is the future. Like, I wouldn't say I'm close enough yet to say anything like, hey, like I see this thing that's going to happen in the next 2 or 3 months. But like, this is completely top of mind for me is like, who are we going to partner with that has a platform with enough scale and enough point of sale data that we can tether that point of sale data to our brands and to some version of inventory and kind of connect the dots there.
Yeah.
I'm really excited about that opportunity.
Absolutely. And that actually ties a little bit into the last subject I wanted to talk about, which is AI. One of those business plans I've seen every year for the last like 10 years is like an AI that recommends clothing. What goes with this dress, and the AI shows you a scarf, that kind of thing. Is that reality? Is that an area where you're thinking of how you can change shopping behavior, or am I just like, talking crazy talk?
No, I mean, I think that I think the efficacy of personalized experiences, like I think everybody's been talking about personalized experiences, but actually delivering on that value proposition, I think AI makes that much more democratized for people to create better experiences. I think about it from a business perspective. Like I'm thinking about this, like my editorial calendars, for example, right? Those are text-based editorial calendars that go into Airtable. And when you think about the monetization of those things, right? If you thought about the process from end to end of when something in our creatives' minds goes into Airtable for an editorial calendar to the process and how many people touch it and how manual it is for that opportunity to get into the hands of a marketer that's going to fund it, that is where like I'm like, 100 people, 2 or 3 months. Like, it is laborious and manual. I'm really like, and again, it's just kind of like the beginning of this train of thought, but I'm really excited about how do we automate and bring more speed to market around getting what is in our editor's head in front of a marketer for them to activate against as fast as possible on walled gardens. Like, to me, that is the complete future of the publishing industry. And I think AI has the ability to really bring that to life.
That's really interesting. It's got me thinking. All right, we're going to cut it there, take a quick break. We have an enormous amount of news of the week that Eric will walk us through. Hopefully we'll have enough time. So, Craig, you'll stay along and give us some color commentary. We'll be right back. This podcast is brought to you by Live Intent. Whether or not Google ever decides to remove cookies, Live Intent's Hero, that's helping identity reveal opportunity, offers a solution that transforms non-addressable audiences into addressable inventory using first-party data. Hero is scalable, interoperable, and integrated with major industry players, providing a robust framework for navigating this new era. See how Hero can help you quickly unlock your inventory at liveintent.com/hero. That's liveintent.com/HIRO.
All right, and we're back. This is a big news week, so let's get right into it. We've got M&A news, we've got earnings news, we've got AI news, we've got somebody at Nike blasting the company. We got it all. So M&A. Let's start from the top. Moments ago, basically, an announcement was made that confirms something we said last week on the pod, which is Outbrain acquiring Teads. They acquired it for $1 billion. This is a big deal. This is certainly transformative for Outbrain. So this is, pretty awesome from my perspective. And there was some questions around how a deal like this would be financed, just given the market cap. The financing was, basically cash on the books. I asked Perplexity right before this how much cash Outbrain had on the books, something like $160 million. External financing from some of the big banks, and some stock changing hands. So this is a big deal. This is probably a continuation of a trend that we've been seeing of companies coming together to build much larger businesses that are complementary. And I think the thesis on this pretty straightforward, right? You've got Outbrain, which is focused on performance, strong publisher relationships, and Teads focused on the brand side, focused on videos. So put the two together, you'll probably have an interesting new business and entrant to the category. Any thoughts from you guys?
I have a couple thoughts. First, the one number that jumped out to me from the announcement was that the total media for this entity, media sold, will be, I think, $1.7 billion. And that makes it bigger than Twitter and X by a pretty big margin. It kind of puts it right around the size of Walmart. So if you think about where media buyers have to spread their wealth, it starts consolidating. Fewer and fewer places to buy, each one of which has more power. 1.7 is a pretty big number. The other thing I'll point out is the questions people have had around why so much debt, is it sustainable, that sort of thing. Because I think it's like they're going to have a pretty big debt load. And I think the way to think about that is that Outbrain's stock was not being appreciated by Wall Street. It was trading at less than 1 times revenue. And as a result, it wouldn't have made sense to buy this with stock because the stock was valued low, but they are very cash flow positive, so debt makes sense. It's kind of like an LBO. Obviously it's higher risk, but they have a lot of cash flow, so good for them.
It's probably pretty good timing if you're on the Outbrain side too, because with all the IAB changes happening in terms of in-stream versus outstream, there's a lot of real estate on websites that's currently getting monetized through in-stream based off autoplay that now becomes all outstream. And Teads to kind of be like the de facto and taking over a lot of that real estate monetization, I think it's interesting timing because we really haven't seen the impact of that yet, because that's really getting phased in now.
Yeah.
I'm sure the Teads people are not happy to have the name Outbrain. It reminds people, change the name to InBrain.
Yeah, exactly.
T-Brain was on Twitter.
T-Brain would be good. Yeah,
they really.
Like that.
I'm going to have a plea to the executives if you're listening. Rename your entire company. Don't use either of these names. Get a company, a branding agency. Rename the company. Throw an X in there just for fun. Just do something.
And you're like, if you need help. I'm the guy who did the Monopoly report, so
I'm pretty good at naming things. I will help.
Yeah. Get your wife actually to help, not me, not you. But I'm kidding.
She's already texting me various corrections to what I said. I'm not going to give her airtime. She can use social media to criticize this pod.
Aperium will be happy to represent you in this transaction, Ari. All right. So another big transaction. Publicis bought the influencer marketing platform Influential for $500 million. This is a pretty big transaction. Influential reportedly did $150 million in top line last year. So I think, pretty reasonable from a growth standpoint. And it seems to be, not just a matchmaking between brands and creators, but, strong sort of technology platform for discovery and AI, so on and so forth. Craig, actually, interested in getting your take on this one. Do you, as a publisher, and just given your social strategy, do you work with creators in this way? And, is these types of platforms part of, your whole go-to-market?
It historically hasn't been, but very recently we've been really, really focused on this. I think what you'll see, and you see this with Omnicom, like OMG has a group called Creo, an essentially version of their Influential. So when I saw this news, I kind of connected the dots. So I think what you see with holdcos is creating a lot of, I would say, like product-based centers of excellence that the individual holdcos then, so if you're, Starcom or Spark, now that you have Influential, it's like you have one of your clients and now you can scope in kind of like this product COE as part of that work and kind of feed the product suite internally versus needing to partner externally. And so I think that's a really interesting model. So how we've been evolving, and again, this is new to your question, is we always talk to the media agencies and then we talk to the corporate holdco teams, when we're doing like endeavors and things like that nature. We've been more focused on working with these new kind of like product COEs to make sure that Conde Nast offerings are incorporated within these COEs so that, if it's if it's a Hearts and Science client or a PhD client and they're going to work with Creo, well, Conde Nast is now incorporated into Creo's offerings. And so like, we're kind of like trying to make sure that our solutions are on both sides of the fence. And so I see Publicis potentially trying to do a similar thing with this acquisition. And so how we'll try to play it is like making sure we're talking to the media agencies, but then also talking to the COEs as well.
Yeah, I want to build on this too. I love this idea of this sort of product-enabled center of excellence because I think we could put this acquisition in context with Interpublic's acquisition of Flywheel for $750 million, which is very similar, even though it's in the retail media space. And we actually, next week on this podcast, we'll have Mark Menino, who's the GM of Flywheel. So we'll be able to ask him about it. But my understanding is that Flywheel's special sauce was that it was a retail media platform that was very services heavy. So that kind of fits in an agency more than in sort of a giant tech company or some other exit. So I really like this. I really like big agencies investing in product.
Yeah, it makes sense. And they're all going to differentiate in different ways. Clearly there's like the commerce angle, the creator angle, and there's probably a few more. Okay, cool. Moving on. Two smaller exits, but worth shouting out. First was Beyond Ordinary, which is the company behind Possible, the event. Both, I think Ari personally and my firm were investors, was acquired by the Hive Group. Hive owns Shop Talk and other tentpoles. So it'd be neat to see where they go with that one. And then another one, again, sort of breaking this morning. This one's interesting. Reddit acquired Memorable AI, another portfolio company of ours. So Memorable, if you're not familiar, it's like a creative testing startup, and they used AI to, predict how a creative would perform against brand KPIs, and then use Gen AI to actually make those improvements. So like test and optimize creative before ultimately a campaign goes live. Sounds like Reddit's aspiration is to build their own PMax, build their own Advantage Plus, and you need these types of capabilities for it. So it's a really talented team and a good company. So I think it's a very interesting move by Reddit to move into this category.
So you had two exits this week?
I had two exits in 1 week.
That's why I'm not wearing the Imperium t-shirt. I put it away. Sorry, my bad. I thought I was wearing the Imperium t-shirt.
Today's the day to be rocking the jersey for sure. One final one. Interesting rumor is Kinetics and JW Player are rumored to be merging. JW owns the JW Player, which is very sort of like sell side and has a lot of relationships with media owners and broadcasters. Kinetics, I think has an SSP with demand integration. So it's a little bit, on this idea of like kind of two businesses that are fairly scaled, focusing on different parts of the market, coming together, but specific to video.
Yeah, I've been an advisor and investor in JW for a long time. I think you are too. So maybe you'll do third exit of the week. We'll see. But I think Kinetics does have a video player of its own. And so there's sort of a different approach here. So Kinetic goes to long-tail publishers and says, we'll give you a video player, we'll give you syndicated content, and then we monetize it. And JW maybe is a little bit higher in the torso, and they'll say, well, we have a player that has a SaaS fee, and you can run everything. And then as an add-on, we'll help you do yield management and monetization. So I think the fit here is actually pretty good in that these are both companies that are pretty successful with a good amount of revenue, but maybe too small to IPO or too small to be, a really major outcome. So combining them and having synergies kind of gives them a pretty strong position in the publisher base.
I mean, I think the reality, no matter how pessimistic or bullish you are, like the open web is going to keep getting smaller. So I think vertical integration around different services that help media companies monetize their open web is probably a trend that I would imagine continues and makes a lot of sense.
Speaking of naming, let's just quickly on naming. So the JW player, you may not know this. It's named after a guy named JW. He works there. He's an employee. I think he's the CTO. He's a good guy. So I think that's just kind of funny. And when this company first got created, they had a different name. It was called Longtail Video. And that actually sounds a lot better, but it doesn't when you try to sell ads because no one wants to be in Longtail Video. So they changed it back to JW, and I bet Mr. JW that's his first name, I guess.
It's been a little while, but I believe his name is Jerome Waring.
Yes. Okay.
Wow. That's
pretty good.
By the way, is there like an Adam Newman thing where he licensed his name back to JW Player, or what do you think? No.
he's gonna hold out as part of the acquisition. That's getting paid millions of dollars for the JW.
That's awesome. Okay, cool. All right, that's M&A. That was a lot. We'll move on. We'll go through earnings quick and talk about AI after this. So 2 things to note on the earnings front. So Meta came out and beat handily. So Q2 revenue was up 22% year over year to 39.1 billion. Stop there. 39.1 billion in a quarter. That's outrageous. And then interestingly, both ad impressions and CPMs were up 10%. Year over year. So they continue to execute really well. We'll pull 2 quotes from Zuck in the earnings call because I think I'm going to have people like super riled up the same way that Sam Altman's did. So I'll say them now. I'll let you guys react. So first, in the coming years, AI will be able to generate creative for advertisers as well. And we'll also be able to personalize it as people see it. So I think that was interesting. Then number 2. Over the long term, advertisers will basically just be able to tell us a business objective and a budget, and we're going to do the rest for them. Give it to me. What do you think, guys?
Sounds like Sergey Brin in approximately 2004, which statement made people so angry that it made Sir Martin invent the term frenemy. So everything old is new again.
Again, like when you think about how these businesses were created, they were created with clicks as a currency. And this is where I just think that now that these are consumption platforms, not discovery platforms, you're not transacting off of clicks. Like, I don't know if you guys saw this quote. Joe Marchese sent it to me earlier this week that I thought was great. It was part of the Nike's earnings. And it was like, I think it was the CMO, but don't quote me on that. He said, Nike invested a material amount of money, billions, into something that was less effective but easier to be measured versus something that was more effective but less easy to be measured. In conclusion, an impressive waste of money. And so it's like, I think what they're building is 100% like, this is like an amazing evolution from like linear TV and traditional advertising for sure. But I think where it's like, just give the platform your KPI and like your company's name and let us do the rest. Like that's, to me, it's going too far. I would say, not that, I don't know if that's quote is kind of what it's saying. It sounded like that though, but I don't know.
Yeah, that's the quote. The quote is saying, hey, just let us know what you're looking to do. Let us know how much money we can, kind of hoover up and we're good to go. So this is pretty aggressive. Was that quote on Nike, was that from that viral LinkedIn post or was that actually from earnings?
Oh, no, that was from the viral LinkedIn post. I think it was after the Q2 when they lost 25 billion in market cap. I think it was a former CFO that said that, that LinkedIn post. It was, I mean, that quote for me is like, that's such a rallying cry.
Yeah. Let's talk about that now. Let's cover it because it was pretty notable. So basically this person put the blame on Nike, all of their recent woes on some strategy stuff, which was, focusing on D2C, focusing on like their membership program and programmatic. And when, they mentioned, just like this overemphasis on programmatic, obviously ad tech Twitter lights up and everybody gets really, really mad. All right, what was your take on that whole thing?
Yeah, I think it's easy to point the blame at programmatic because programmatic doesn't solve all problems. Programmatic's great. I think if you're listening to this podcast, you probably think programmatic's pretty great. But it doesn't solve all branding problems. It's not a comprehensive business strategy to just put your money in programmatic, or for that matter, giving your money to Meta is not a business strategy for creating the next Nike or sustaining a brand like Nike. You have to do all kinds of things. And I really do love that quote about measurability, because there are media that are hard to measure, and that doesn't mean they're less effective. There were some people in my threads who were literally saying, if you can't measure it, it is not effective. And I think that's just really not accurate. I think that there certainly are media like outdoor that are pretty hard to measure. You can try, but it's pretty hard, and they can be quite effective.
Yeah, and with what Craig was saying earlier, right? Your whole thing about magazine covers and exclusive events, they drive the culture, right? Like they're so inherently hard to value, but we know that they create so much value.
100%. It's like, and I think this is sometimes where the conversation gets lost, because it's like in the marketplace, it's like, I'm not saying like in this conversation, it's not don't spend on Meta. It's how are you spending on Meta? And that's where I really think that, again, like our strategy, it's like, I want to put a premium offering on top of Meta, because Meta is incredible. So like, Ari, to your point, like it's not saying like not Meta or just give your money to Meta, but it's how are you doing it on Meta? And I think that's where it's like, oh, well, if it costs $1 versus 50 cents, if I do it myself, I should just do it myself for 50 cents. It's like, no, it's our brains, like human nature is like, nobody likes self-promoters. Nobody's like, hey, like, let me tell you how smart I am. But all of social media is essentially marketers with their handle and their creative, telling their story, hawking their products. It's like there's a whole PR industry that was created based off third-party, credentialing of products or services. And it's like we've completely lost sight of that in search and social. And I really hope that these moving from discovery to consumption kind of brings back that era of like, understanding the importance of kind of third parties. And hopefully, the Publicis Influential thing is probably a step in that direction too.
Yeah. Okay, so this Perplexity Publisher program, the 3Ps, is live. Basically, as we've all kind of watched over time, users are likely going to get more info in their news from LLM-based search engines and not necessarily from publishers, and that obviously is a negative for publishers. So Perplexity is trying to be helpful here. So the program basically works like this: Perplexity is going to be introducing ads through related questions. So you can type in a question to Perplexity, you'll get answers, but then you'll get a suggestion of a related question. Brands will supposedly be able to sponsor a specific follow-up question to an initial prompt. And then when a pub's content is sourced for that answer, the publisher will get a rev share. So it's a little bit complicated, but probably relatively so straightforward. And then pubs will get access to analytics and APIs and so on and so forth. So this is basically what Perplexity's future is. Perplexity says that ads will be their main business model, not subscriptions or licensing.
It reminds me of the Satya Nadella quote from the Google antitrust trial, the last one, where he said the largest software market in the world turns out to be advertising. He's not referring to selling SaaS services to advertising companies, or just referring to Google and Meta's income, which vastly exceeds the packaged software business.
Did you see the monthly bill that TikTok is running up on OpenAI?
No.
I don't want to misquote the number. It was, I think, 20% of their revenue is coming from TikTok on a monthly basis, though. Something crazy.
I'm watching the Olympics, and it seems like the number one sponsor of the Olympics is Google Gemini. And it just seems like burning a giant pile of cash. I mean, Google has the cash, so they could burn it wherever they want. But no one's signing up for Gemini. It's kind of hard to sign up for. If you go to your Google account, try to find Gemini. They'll give free trials. You have to sign up for a paid trial. It's kind of nonsensical marketing. And I think we're about to see a sort of a crash in the idea that consumers are going to pay for AI.
Yeah, that makes sense. All right, we'll end it with one more, and this one might be the most interesting walled garden news of the week. So Apple is considering an ad tier for Apple TV Plus. There's a rumor out there that comes from an apparent meeting that Apple execs had with the UK Broadcasters Audience Research Board to discuss various options for tracking ads on Apple TV Plus. This would be pretty huge, if true.
Yeah, I covered Apple's various monetization in my newsletter, I think, last week. You should find it because in that newsletter, one of the really useful pieces of content was from Eric Seufert's mobile dev memo that he let me use with his permission, which showed the pricing differentiation going on between free and paid with Netflix, Max, and other platforms. And basically what happens is that as you release an ad-supported model, you can raise your subscription rate, and therefore your overall revenue goes up in two different ways. So it's pretty compelling, and I have to imagine if Apple wants to continue spending what they're spending on content, and especially on sports, then ads are going to become much, much more important than they are right now.
It's interesting to think what their approach will be, if they'll take kind of like the more industry approach, or they're going to try to kind of create some new frameworks or guidelines, similar to how they kind of try to monetize Apple News.
Right. They tried with iAds, 10 plus years ago to reinvent in-app advertising, and it was a pretty big failure.
I was at AdMob at the time, so I was competing. Steve Jobs was pitching it personally. It was like, how do you compete against that? Like, you're
exactly right. But the funny thing is, I mentioned this in my newsletter, and that Apple has wiped all traces of Steve Jobs and iAds off the internet. There are no videos of him introducing iAds, even though I saw it with my own eyes. I can't be gaslit. I saw it, but it does not exist. You get content removal notices wherever it used to exist. They're just so embarrassed about that whole thing.
That's wild. I remember him saying mobile ads suck. We're going to change this. Like, it's in my mind, but yes. You can't find it.
So I remember when I was selling against it, it was like they had an app that had all of their campaigns. It was like the world's best prospecting tool in the world. And the price point was $1 million. So I'm like,
I remember.
Okay, here's the 20 advertisers. Hey, I can sell you something like this for $250,000. It was like, it was amazing.
All right. This is a ton of news. Craig, you were great. Ari, you want to take us home?
Yeah, absolutely. It was a great conversation. So, Craig, thank you so much for being here. Eric, thank you for being here as always.
Thank you.
Thank you, guys. This is so much fun, man. I really appreciate it.
Thank you for subscribing to Marketecture. New interviews are added every week at marketecture.tv and your favorite podcasting app.
Thank you for listening to the Marketecture podcast. New episodes come out every Friday, and an insightful vendor interview is published each Monday. You can subscribe to our library of hundreds of executive interviews at marketecture.tv. You can also sign up for free for our weekly newsletter with my original strategic insights on the week's news at news.marketecture.tv. And if you're feeling social, we operate a vibrant Slack community that you can apply to join at adtechgod.com.